Yesterday, both the euro and the British pound came under pressure from US statistics. An early trade, the European currency failed to rise above the previous session high amid mixed data from the euro area. Germany's unemployment rate remained unchanged at 5.9% in February. German retail sales fell unexpectedly in January, down to 0.4% against expectations of a 0.5% rise. In France, GDP growth for the fourth quarter of 2023 was revised upwards to 0.1% and household consumption fell. Such ambiguous statistics helped the market maintain equilibrium. Then traders shifted their focus to the core U.S. personal consumption expenditures price index. The indicator increased by 0.4% from the previous month in January and 2.8% from a year ago, in line with consensus estimates. Such a steep rise suggests that the Fed will hardly rush to cut interest rates. Data on U.S. consumer spending also met analyst expectations, while U.S. personal income rose by 1%. Well, above the forecast of 0.3%. This once again potentially points to lingering inflation pressures and the Fed's further steps to combat inflation. Today's macroeconomic calendar includes final data on manufacturing activity in the UK, the euro area, and its member states. Statistics are expected to be rather gloomy. If data is revised down, the European and British currencies will extend weakness. In addition, it's worth paying attention to data on consumer price growth in the 20 nations sharing the euro. The inflation rate is expected to come in at 2.8% in January 2024, down from 2.9% in December. If consumer prices do slow, the euro will suffer heavy losses amid expectations of interest rates cuts by the European Central Bank. The focus of market participants will be on the core inflation rate in the euro area. Preliminary figures indicate a dip in the core CPI from 3.3% in January to 2.9% in February. This could also weigh on the euro. Traders may also take notice of U.S. manufacturing activity data. The ISM manufacturing PMI is forecast to improve to 49.5 in February but remain below the 50 mark that separates growth from contraction. If the indicator returns above the 50-point threshold, demand for the dollar will increase. In addition, the University of Michigan is set to release its final readings on consumer sentiment and inflation expectations. What is more, a number of Fed officials are scheduled to speak today. Perhaps they will comment on the latest economic data and shed light on further policy steps. Now let's move on to technical analysis. According to the 1-hour chart, the euro-dollar pair is trading in the sideways range bounded by the levels of 1.0856 and 1.0797, with the 0.829 mark acting as its middle line. A rise followed by a false breakout at 0.829 will create a sell signal, dragging in the euro down to 1.0797. At this mark, I expect bulls to regain control of the mark. A false breakout at 1.0797 will generate a buy signal, bringing the euro back up to 1.0829. If the price breaks through and consolidates above the level, the volume of long positions will increase, with the euro climbing to the one-week high of 1.0856 and even 1.0886. At the mark of 0.886, I recommend going short on the rebound to catch an intraday correction of 25-30 pips. Short positions at 1.0856 and 0.829 can be considered only amid a false breakout. Alternatively, one can sell the pair after the price breaches and fixes below 1.0797, given weak data from the euro area and strong economic reports from the United States. This is the most likely scenario. In this case, the euro will plunge to 1.0763 and probably 0.735. At the level of 1.0735, it would be a wise decision to go long on a rebound, counting on a 25-30 pip move. Going long at 1.0763 and 1.0797 will be relevant in the event of a false breakout. Speaking of the British pound, it remains under pressure. Bulls are expected to take the lead at around 1.2612. If the price dips below yesterday's low but then returns to 1.2612 and forms a false breakout at this mark, a buy signal will be generated. Thus, the pound sterling is likely to advance to 1.2649. A false breakout at this level will create a sell signal, pushing the British currency down to 1.2612. If the price breaks through and fixes below this mark, sterling will extend losses, diving to 1.2581 and probably 25.59. At the level of 1.2559, traders are recommended to go long on rebound to catch an intraday correction of 15-20 pips. Long positions at 1.2581 and 26.12 can be opened only amid a false breakout. In case of subdued selling activity at 1.2649, going short will be relevant at the levels of 1.2678 and 1.2706. Good luck and have a great weekend.